Hi, and welcome to week 5 of class. We're just moving right along here. We're moving into a new section of the class where we talk about working capital management, sort of the daily grind or the kinds of decisions that finance analysis deals with on a regular basis. So, in it goes over 3 chapters. We're going to cover chapters 6 and 7 this week. So let's look at chapter 6. We're going to talk about working capital and the financing decision. So we're going to explain how working capital management involves financing and controlling the current assets of the firm. Okay. I want you to recall that you have to make a distinction between current assets, or the ones that are easily converted to cash, and those that are more permanent. And we make different decisions for each of those asset classes. Recognize the financing of an asset should be tied to how long the asset is likely to be on the balance sheet. Um, we're going to explain why long-term financing is usually more expensive than short-term financing based on the theory of the term structure of interest rates. So pay close attention to that. Um, I want you to recall risk as well as profitability, determine the financing plan for current assets. So both those components work into it. And illustrate why expected value analysis may sometimes be employed in working capital management. Um, in expected value analysis might go under different names in different firms, but it's all basically to achieve the same thing. Okay, so that's chapter 6. Then chapter 7, we're going to talk about current asset management. We're going to call that current asset management involves the management of cash, marketable securities, accounts receivable, and inventory. So when we think going back to our balance sheet, we look at current assets. Those are the major categories of it. We're going to explain what is involved in cash management. Just a side note to it, interestingly enough, companies are not well thought of if they have too much cash. Now that may seem a little bit contradictory, but it actually makes sense. When when you buy stock in a company, you give them your money and you expect them to do something with it, get and gain a return. And if they just sock it away in cash, it's like you can do that on your own, right? I mean, you don't need them to do that. So cash management is actually a really important part of most organizations. Explain what is involved in the management of marketable securities. Detail the requirements of accounts receivable management. We're going to determine the level of inventory necessary to enhance sales and profitability. Always a tricky question in these days, particularly challenged because the temptation is to want to inflate inventory because of supply chain issues, but you have to make good financial decisions revolving around that, and understand that the less liquid an asset is, the higher the return is going to be required. So that's chapter 6 and 7. Good luck with it. If you have any questions about any of it, certainly let me know. Um, and good luck.